This is Little by Little with Andy Schectman.
All right, welcome back, everybody, to another episode of Little by Little. I am very, very excited to welcome into the show mining executive and precious metals analyst extraordinaire, LBMA superstar, David Jensen. I follow David's work extensively. I think you all should too. He has an amazing Substack, and if you want to know what's going on with the LBMA, he is unquestionably the guy to follow. So, David, good to have you here, my man.
Good morning, Andy. It's great to be with you.
Yeah, no, the honor truly is mine, and I will be flat out and tell you that so much of the stuff I talk about, I have gathered from your work, and I want to give you credit. I always try to give you credit when I am publicly mentioning that you're someone that everyone who's interested in precious metals should follow. I do have a list of questions, but let me ask you, let's just start off at the top. What's your main focus right now? I know what it is, but to let the people out there know your main focus, and then we'll get into my questions. If you were trying to explain to the public what you do, what you focus on, what is significant to you, in a nutshell, what would that be?
Well, it's the London silver market. It is the world's primary silver market for physical silver price discovery, and the daily auction price that they set there, the daily silver price that they set in London is the one which I'd say 80 to 90% of mining contracts utilize to set the silver price that is recognized for the delivery of metal. So it is an absolutely crucial market for the world's gold and silver price discovery. It's a very different market from the Comex, which is primarily a hedging platform. And I mean, you can get silver delivery in New York, but there are numerous rules written into the Comex rulebook which allow for forced cash settlement.
Right.
And the way that London is different is it's a private market in terms of each contract is different and is written between two parties, and there's no real exchange that can intervene into those contracts. The contracts are governed by the common law and contract law in the UK, and even the Prime Minister and the King are subject to that law, as we know from Magna Carta. So it is the most important global gold and silver market in London, and that's what draws my focus to it.
Right, and to your point, the Comex, like they did to the Hunt brothers, can change the rules to suit the exchange, whereas in London you are dealing with a peer-to-peer, over-the-counter, kind of like eBay, so to speak. It's one-on-one, and eBay doesn't come in and intermediate or be a judge or jury. It's a more true way of doing business, I guess, is how I look at it. But suffice it to say, is the Comex and the LBMA two sides of the same system, or does one ultimately depend on the other for price control and stability? I guess would be my first question. A lot of people ask me that.
Yeah, well, I mean, when London's closed, you can materially move the price of gold and silver with the futures market in New York. It does influence the spot market, or has historically. It's becoming less important now that we've got true shortage in the market, and we see the spot price, the cash price for gold and silver, for silver, is above the futures price, the December's futures price still. This is even after an injection of 50 million plus ounces in the last month back into London after their available metal ran dry in that market. So, and that to me is the crucial thing. Is we had visibility in October of a market basically pausing or stopping into a forced stoppage because of lack of silver liquidity offered into the market. So New York is a hedging market. It's a futures market. London does offer forwards, but more than 90% of the trading there is in the cash or the spot market for immediate ownership and immediate delivery. And even the forwards that they offer there require you to acquire a spot contract in order to create a forward. So if they say, well, we have some forward trading here, it's like, yeah, but those contracts are all based on a spot contract as well.
Right. Now, you've described the LBMA as being structurally fragile. And you just mentioned that the market where the spot price is higher than the futures price, this is called backwardation, and something that we saw to an extreme level a few weeks ago.
Yeah.
And then, as you mentioned, the infusion of 50 million ounces, kind of a lifeline, took care of that. But here we see a slight increase in backwardation again. In your view, the backwardation, along with perhaps maybe you can discuss the unallocated positions and the overwhelming volume of paper, gold versus silver versus physical, explain what are the key points of failure that you see, maybe starting with the backwardation.
Yeah, well, we did see on October 10th, the market seize up in London. And that is despite the fact that they had roughly 790 million ounces in the vaults in London. But of that 790 million ounces, approximately 650 were held by exchange traded funds, so should not be offered into the market. And the remainder, which was approximately 140 million ounces, was not offered to market. So what we got there, Andy, was on that day, we caught a glimpse of where the bottom of the barrel was. And the London market actually bounced into that bottom of the barrel. So even with 140 million ounces not held by the ETFs, there was no silver liquidity in London. So we know that market is tapped out circa 140 million ounces of non-ETF gold. So with the addition of, notionally with the addition of 54 million ounces to that market, they've got a little bit of liquidity. But I mean, even the LBMA now in their statistics state that they're trading on an active day, they're trading more than 700 million ounces of silver every day in the cash immediate delivery market, immediate ownership and immediate delivery market. So if you've got 50 million ounces, but you're trading 700 million ounces a day in these cash contracts, and that speaks of an open interest or total claims in the market of at least a couple billion ounces, you can see how weak this market is, and that the market has actually failed. It's just a matter of the London market has failed. It's a matter of it, silver purchasers recognizing this, and I think what we're seeing today with these 4+% price moves after the price had come off 10-15% here a couple of weeks ago, is that investors and purchasers are stepping in to acquire what little silver is left in that market. London right now operates on a silver in, silver out basis. If they get silver, they can deliver some silver. If they don't get any, they are unable to deliver silver. And we saw that from that signal. They've got a 50 million ounce buffer right now, but they are dependent on continual deliveries of silver to meet delivery demand from these cash contract holders.
Yeah, I cite your information regularly. And when we talk about the LBMA, they, for a good portion of the year, it's a T+1 exchange. T for the trade day, +1 to settle on the third day. Those bars should be moving.
Yep.
But as you know, it was 8 weeks because we were told the Bank of England had a shortage of manpower and trucks. And I cite your figures regularly in the respect that, you say there's roughly 2 billion ounces of deliverable contracts out there against 140 million ounce float. What could possibly go wrong? Or trading 700 or 800 million ounces a day in deliverable contracts against 140 million ounce float. What could go wrong? Or even Bruce, I forget his last name, Ikamoto. I'm sorry, yeah. Bruce. He talks about 3 million ounces of platinum traded every day with 0 platinum in the vaults. What could go wrong? My question to you that I think is paramount to your analysis is, how confident are you in the LBMA's reported trading volumes and inventory figures? Kind of the same way I wonder the CME group? How accurate are their figures on the Commitment of Traders report? But how confident are you in the LBMA's reported volumes in trading and in inventory figures?
That's a good question. It's very difficult to say. You're dependent on these the banks, which have on numerous occasions shown themselves feeling free to operate outside the law. Number one.
Yeah.
But I mean, in 2013, the LBMA was indicating that they were trading about 2.5 billion ounces of silver a day in the cash market. 2.5 billion in a world where you're producing 800 million ounces a year. Now suddenly that number has dropped to around 700 million ounces a day. So we really don't know. It's an opaque market run by banks which have been charged with fraud on numerous occasions. So we really don't know. But the idea that the 140 million ounces is afloat, I mean, that's the amount of silver not held by ETFs. But if you want to talk about a free float, what is available to London when you're at the 140 million ounce level right now, the free float is zero.
It's the 55 million ounces that they got injected in there.
Right after that. So we've got about 50, and we don't even know of that 50 million ounces, how much of that is held by private investors who are willing to deal that into the market. We do know the benchmark on October 10, there was 140 million ounces in the vaults not owned by ETFs, and that the free float on October 10 was roughly zero.
Wow. That's crazy. That's really crazy. And now we get into some questions that I think kind of try and connect the dots. So we've talked about the internal weaknesses, but the external dynamics are shifting rapidly too. And let's start with talking a little bit about the global East versus the global West shift. Now, for years, all of us have talked about this steady flow of physical metal from West to East, with China now centralizing its metal through the Shanghai Gold Exchange. And now we're told restricting silver exports, along with the U.S. classifying silver a critical mineral, and they too can restrict exports. Do you see more so forget about the U.S., I just want to throw that in there as a plus. That's happening too. But do you see what's happening in Shanghai as a direct challenge to the LBMA's role in global price discovery, and maybe even more so towards market dominance? Is this a real threat over time?
Well, I guess it depends on the various axes of power, who aligns with whom. When we look at the BRICS nations and the countries that are friendly to the BRICS, it's more than half of the world's GDP now, and we really rely on the London market in terms of price discovery of gold and silver, in terms of feeding information into the bond market. We learned historically in the 1970s how essential gold and silver were as a warning system of excess currency creation. Silver went up by 24 times in 9 years, and gold went up by 21 times in 9 years between 1971 and 1980. And in 1987, the LBMA was created, and the daily fix, as they called it, gold and silver, was created using these promissory note contracts, which essentially moved the market away from trading metal to a market that traded promises for immediate delivery of metal. And for more than 20 years thereafter, we had the gold and silver signal was switched off while very loose monetary policy was run by these central banks. They called that, the Wall Street Journal wrote an article in the 1990s talking about the Great Moderation, which was that, this is incredible inflation after we've dumbed down the inflation measure through the CPI is showing us that we've got no inflation, and gold is telling us that we've got no inflation, and yet asset prices are going to the moon. And this is, we've really hit now on central planning, monetary policy nirvana. And I think what we're going to have come out of all of this, Andy, is a fragmentation of the world's gold and silver markets away from these major centers, and everything is going to become local. and governed by local law.
Yep.
And I think that capital investment and acquisition capital is going to go to the trusted sources for metal, and that is still to be determined. Which markets are going to be trusted, but I think China would like to be the focal point of the world's price discovery and become the dominant force. But there's lots of we've seen unbelievable levels of corruption in China over the decades. And I think people would have to be quite naive to look at these now as the fair dealers in terms of setting the global price of gold and silver. So I think that everything becomes local after this, and it's who has the metal and where are the repositories located in terms of laws that enforce the contractual right to acquire metal.
So if you were inside of a major bullion bank or central bank today as an advisor, what's the one thing that you'd be most worried about when it comes to the LBMA's future? And as an aside, to your last point, do you see any signs that perhaps key institutions are quietly preparing for a breakdown or a shift in the system?
Well, the first part, if we've got of the order of, let's say, 2 billion ounces of claims in the market, and we have $100 price move up in the price of silver, if those claims have been underwritten, offered into the market by the banks, $100 move in the price of silver translates to a $200 billion liability. And that gets quite messy quite quickly on a bank balance sheet. So that would be the biggest concern is the fact, and I can kind of see it in a lot of the commentary which is being written on the bullion banks is, we're relieved now that the price of silver has run higher, and now we're going to see more silver come into the market, and that's the end of the run. That's the end of the squeeze. And I think this is where at a very nascent stage of this, at the beginning of it, not in the middle or not near the end of it. And so I think the crucial thing here is that users of the metal and, a nuclear power plant, just to build one takes 5 million ounces of silver. We know there's a big push for energy. But I think the biggest role of silver and gold are as monetary assets and safe haven assets. And I think that this is what is going to get out of hand here quite quickly for the bullion banks, is that they've sold promises into the market that they can't possibly keep.
Before you answer the second part of any institutions quietly preparing for a breakdown, maybe shifting their exposure, do you think that a failure to delivery is possible? And have you ever run that out? Like if a major bank, Standard Chartered or Deutsche Bank or whatever, were to have a failure to deliver, could that also possibly create a far greater, let's say, contagion, if you will, because these banks are not just bullion banks, they also have their finger in the pie of everything, a massive breakdown in trust.
Yeah.
Do you see that as being possible, the start of something that kind of breaks the system?
Well, I think the implied lease rate for silver a couple of weeks ago hit 39%.
Yeah.
And the implication there is that we did have a default, because you could be sure the actual lease rate would be higher than that. So I think we've had a default, and I think what we're now in is a rolling scenario of what happens when you have a default. And that is why I see silver now in the cash market running relentlessly higher again.
Yeah, it's up a lot today. Last I looked, let's see, the futures price right now is 53.42, up $2.67 or 5.27%. And if you followed the guys in GATA, Bill Murphy, Chris Paul, there was a 2% rule my whole career. Like it never goes higher than 2% in a day. We're up 5.5 right now.
Yeah. So
that
I think
would support what you're saying.
Yeah, I think London, essentially, the London silver and gold market is a smoking hole right now. And what we see is acquirers, though the industry especially that absolutely needs the metal, are stepping in and trying to acquire the metal as they can. And I don't think this process is going to take too long. I think we had a default. The lease rates were telling us that somebody couldn't get metal, the implied lease rate. I don't know what the actual lease rates were, but I suggest they would be materially higher than that. And that what we see right now is a pause for a couple of weeks. 50 million ounces come from China and New York and Switzerland to kind of give a little bit of a patchwork covering to what is going on in London, but that we are now in a rolling failure of the London market. Let me put it that way.
Well, and the coordination of the bullion banks for a long time in the collective West, the United States and in Europe, I think we could argue were kind of pulling in the same direction to suppress metals, which were the canary in the coal mine, to support the illusion of strength of currency and of bond markets, et cetera.
Yeah.
And back to that part of the last question, no mean to hold your feet to the fire, but there has to be, and I've always wondered, would one of these banks break ranks and say, I'm out, you guys, I'm covering? Do you see any of them preparing for this breakdown? Do you see it even slightly, or any rumblings of it, or any clues, perhaps?
I don't. And I think we would be the last to know, because that's something that, let's put it this way, if you were a bullion banker and you were breaking ranks, it's something that could get you some negative attention from your compatriots.
Right.
So very difficult to say. If you look at game theory, it's likely happening in subtle ways. But we're talking about some very big players. And if you're talking about a position of 2 billion ounces sold into a market where the metal does not exist to deliver it, and all of a sudden in the last 4 weeks, we've gotten visibility of exactly how little metal is available in that market, I think that things are going to become very, very active here going forward. Now, who the exact players are and what they're doing is very tough to tell. And I think that the individual players would do the best that they could not to let us know what that is. But I think the price action, the fact that the lease rate hasn't gone below 5%, we've still got price backwardation where the spot price is higher than the forwards and the futures. This is very much in action. I think we're going to see a parsing up of the 50 million ounces, and then the next stage, where's the next 50 going to come from?
Right.
The next 50 is going to become very much tougher than the prior 50.
Right. What does the next stage look like? That's a good, and when you talk about backwardation, that's something we don't see very often in commodities, where spot price is higher than the futures, because the futures price takes into account storage and interest and the cost of money. And so that's certainly very interesting. And I think about these things quite frequently, what it would look like to see something like this happen. You talk about the future of price discovery. If the LBMA were to lose control or collapse, what does the future of global gold and silver price discovery look like? Do you have any idea who would lead that transition, or what kind of system do you think would replace it?
To be determined. I don't know. I don't see any up and coming trusted sources. I think that, the New York Comex could potentially be an important player in that. But the problem that you have is that the players in the Comex and the rule book in the Comex, the players are the same players in London. And so there's going to be a loss of trust here. Effectively, the issue here is a loss of trust in the market. For the market to function, you have to have trust, right? And that's what's being systematically destroyed by the revelation of the shenanigans over 40 years in the London market. And the New York market is infested with the same players that are in the London market. But I think everything's going to become local, and it's going to be, do you have any, and for what are you willing to part with it for? And we have to have our people in to have a look at it. And I think that with time, we will have established price discovery centers. But I can't see the next format for price discovery on a global basis for gold and silver. And I think that, as I said earlier, I think China would like to be it, but China has the government stands on a heap of bodies, and it's very, very tough. You look at over 70 million people killed throughout history by their government, and it's very tough to say, well, we're fair dealers and trust us. So.
Well, last question I'll ask you, and it'll just be more of a comment. And I appreciate your time and your candor. I find everything you do fascinating, David, and I can't stress enough people to check out your Substack. I don't miss anything you put out. Just a comment. China is the world's largest silver refiner, and now they have just publicly said that they will be restricting exports starting in 2026, and that all exports have to get individual government licenses, effectively giving Beijing full control of every ounce leaving the country. And this is, as they mentioned, it's a resource of national interest. At the same time, the U.S. has added silver to a now critical mineral list for the first time. They're citing its essential role as a strategic asset rather than simply a commodity. The bottom line is silver is being redefined from an industrial metal into a geopolitical resource. And this to me says a potential supply crisis and rising strategic value by the big money is coming into play. Any thoughts on that before I let you go?
Well, China is producing a lot of silver, but it's a huge portion of it is coming through its refineries, its base metal refineries. And we know that 70 to 75% of global silver production is a byproduct of base metal production. And so China does play an important role in terms of the refineries that it has operating, but refineries can be built relatively quickly. And the flows of concentrate from these overseas miners can be altered quite quickly as well. So not trying to be evasive, Andy, it's just that so much of this is in flux right now. And, so many of the trusted sources are now being seen to be not trustworthy. And it's just a matter of time for this to shake out and to see where the consensus. And we may go through several rounds where, one location becomes favored and then falls out of favor. So I wouldn't write North America out of it yet. Canada and the US. Mexico is another question in terms of the direction it's headed in. And it is the primary producer of silver globally, right? I mean, the US barely makes the top 10 in terms of silver production, and Canada is not even in the top 10. But we're going to see regional centers set up, and ultimately, I think a lot of it comes down to enforceability of law and the basis of that law, and ultimately trust. Who do you trust? And I think we're going to find out now who we can trust, but I think we can certainly see who we can't trust. And I would argue that that's the major bullion banks, including the Chinese. ICBC is a major player in the London gold and silver market in terms of operating their price discovery platform, which is called Aurum. It's run by 4 major bullion banks, including ICBC, JP Morgan Chase, and HSBC as well. So China is not immune to the accusations that they've been participating in a fraudulent system, and we're going to have to see how this shakes out. But in the meantime, I think everything comes down to possession in the short term. I think more and more players are recognizing that if they don't have the metal, that they've got a serious issue if they're absolutely needing it in the future. And that now there's a movement to see who gets the 50 million ounces that were imported into London. And I think that the price action is telling us that small injection of metal into that market doesn't have long to live in the London vaults.
No, it doesn't have a lasting effect for sure. And my 2 cents on that is I think China's playing the game. They're beating us at our own game. The West held the prices down to support the illusion of strength of system and maybe to support the military industrial complex with the massive amount of silver needed. China says, we'll beat you at your own game. We'll join in on the suppression and we'll just stockpile it. But that's just my 2 cents. Again, a lot of the information I gather from you.
Yeah, I wouldn't be surprised if China has 2 to 3 billion ounces of silver that they've acquired over the decades in vaulted stock.
Right, beating us at our own game.
Sources. Yeah, whether it's private or government sources that hold that, it's indeterminate. But there are 25 billion ounces of silver above ground, and it's we just need much higher prices and time for this metal, which has been forgotten because of the very low price level, to be rediscovered and brought to market and refined into the correct form to meet exchange requirements.
Yeah, I guess we'll see. We will see where the trust and the rubber meet the road. David, you're awesome, brother. What is the best way for people to follow you? What's the best way to monitor your continual outlook on what's going on?
Yeah, so my Substack, Jensen, David, Jensen, David, David.substack.com. It's free. I'm a voluntarist, and some people give donations, but it's basically a free service offered. My central focus is to get information out to the public so that they can take a position to protect themselves in what is coming, because this is the greatest market deception history that I've ever seen. And we've got a global debt bubble now that's over $320 trillion, and it's clearly burning down. And there's very few lifeboats out there, Andy, and you and I think know the two that are the most important.
Yeah, well, you're a lighthouse in a sea of uncharted waters, and I, for one, greatly appreciate your effort. I thank you for it.
Thank you.
And we'll continue being one of your biggest champions out there, recommending people check you out. I hope you have a wonderful day. I appreciate you jumping in here with us. I would definitely like to have you back and see what the silver and gold market have in store for us in the coming year. But in the meantime, again, David, thank you so much. I can't tell you how much I appreciate it, and look forward to picking up with you where we left off real soon.
Excellent. Look forward to talking again, Andy.
Thank you, David.
This is Little by Little with Andy Schectman.